I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Hello, Doug. How are you?
John, I'm fine. How about you?
I'm good. Thanks for taking the time to do this. Just briefly, this is take 2 of this episode.
I'm feeling a little deja vu here.
Yeah, it's going to be fun to repeat the story again, but at least it's going to sound better this time because I had been logged in 2 different ways and we're getting all this cross over each other, and it was terrible. I couldn't even listen to it. So I asked Doug, can we redo this and do it soon because people are used to it coming out on Friday, and here it is Saturday, and a few people have listened to it. So apology to those who have, and welcome back if you're listening again, and at least it's going to be better this time. So thanks.
Yeah, you'll see a take 2 in the title of this one, so you can differentiate if you've already downloaded the first one. I was hearing some weird feedback on my end, and it turns out that it, worth redoing. So
yeah, so let's jump right in. This episode is driven by multiple people, but someone in particular, one of my friends at this point. So again, a shout out to Kevin. Thank you he had shared our original "What is the infinite banking concept" with his brother, which is probably the second episode that we released, and And in the end, the brother's feedback to my friend Kevin was, hey, I still don't know what this thing is. So that's why we're doing this. And hopefully we'll be, stacking ideas of the concept one on top of the other and with building blocks. And hopefully, it'll be more understandable after this episode to at least Kevin's brother, and hopefully even to Kevin, because he said he listened to it and it was like, yeah, I could see where somebody wouldn't know. And of course, we thought that, most people are going to listen to this, and maybe it is most people, that they've already got some background. But if you start almost from scratch, we need to start there if we're talking about what this infinite banking concept is.
Yeah, and just we've done a decent amount of episodes at this point, and, our title is the ABCs of IBC, so just worth revisiting, what this is about at its core. So I think it's a great idea.
Okay, great. So I'm going to start off by saying the infinite banking concept is the creation of your own banking system. Again, not the physical bank, but the concept of it. And the concept is key, right? It's a key ingredient here, that it is something that in practicality you can put into place. But again, I'm trying to grab onto the concept, the thinking behind it. And there is a reason there's some infinity to it or infiniteness to it. And we'll get into that. And for me, the first, Nelson talks about becoming your own banker, which of course, Doug, you say what you normally say about becoming your own banker in the book itself. If you haven't read it,
you should probably read it.
Well, yeah. We reread it over and over. We revisit it. And honestly, it gets clearer and clearer, even for those that are not only practicing the concept in their own life, implementing the concept in their own life, like Doug and I am, but also people like Doug and I who are actually teaching others or practitioners for the rest of the public, right? And
I think as you read it over too, things pop out, right? So the first time I read it, I got a basic understanding, or I understood certain things. And then as I read it again, certain things that I didn't notice the first time stuck out. And as I read, that happens over. It's one of those books that is worth continually rereading.
Yep, I agree.
And one thing I wanted to add too is, what you said in the first point there about what this is, that is the why of infinite banking, and it's really important to understand why we are doing this. And that core concept gets lost frequently in the noise that is on social media when people talk about the infinite banking concept. There are a lot of people out there that kind of tout it as being something that it's not, and it's talked about a lot more as kind of this flashy investment, and it's not that. And it's really important that people understand that at its core, the concept is about taking control of the banking function in your life. And Nelson's very clear about that in his book, which is why it's also important to read the book. It's important to understand where the person that codified this concept is coming from.
Yeah, and you would think, right, that we could just say, read the book and you're going to understand it. And we honestly thought that, yes, we want to share this concept with more people, but the reason we've done all these episodes is because we're trying to find new ways of communicating some of the same story that Nelson shares, but trying to, I don't know, dive in deeper, take it from different angles and maybe break it down a little bit. It's a conversation, right? And that's why we decided we'd do it together. Like, let's just have a conversation like we're talking to a group of people, but just sharing, what Doug and I would normally talk about. We would talk about this stuff whether we were recording or not, because it is always about trying to figure out how to communicate in a way that it's acceptable, it's comprehensible, right? So that's what we're going to try to do today. And well, let's jump into it a little bit, Doug.
Yeah.
Nelson calls it the very first principle to understand. And this is it. You're either paying interest, you're always paying interest to a third party lender or giving up the earning of interest that you would gain if you kept control and kept your cash or your liquid capital sitting there, just not ever being removed from your system. And
right. Yeah, either one of those is removing money from your system, whether you look at large finances or even investments. If you're somebody that's purchasing capital equipment for a business, or you're buying real estate, most people are typically either have a line of credit for any of those things, or they get a personal loan, or they use credit cards, or they are saving up money and then paying for that thing and depleting that store value.
Absolutely. Which means that money will never make that money itself. Maybe the other thing that you acquire with it might generate cash flow or extra return, but the cash that you use that you had saved will never be in a system that makes money, and the money it makes will never make money, which we talk about as compound, uninterrupted compound interest too, which is what we're going to get at here, is that your cash will continually grow even as you utilize it, in a sense, by leveraging it. So
yeah, and it's a really simple concept that took me a long time to grasp this one. By the way, we did an episode on this. I think it's called The Very First Principle. So we do talk about this more.
Yep.
But even when you look at the example of, I think, again, I feel like I have deja vu here, but I think it's a good example, and we can talk about it because I think it's the probably the most finance thing that people are familiar with in a car.
Mm-hmm.
So what do most people do when they buy a car, John?
Well, they're either gonna pay cash or they're gonna borrow from. Most people probably, I guess now, borrow.
Yeah,
From the
unless you're buying a cheap
dealer.
used car, most
Yeah.
people are financing that.
Yeah, exactly.
And that's just the norm. Say this is the rate I get. These are the payments that I can get. People look at it in that term.
Mm-hmm.
And there are certainly people that might save up now. What's a new car now? Like 30 to 50,000.
Yeah, and more.
So
Yeah. The trucks, the SUVs, they're
all
all.
the power to you if you're, well, yeah, then you're getting up a lot more than that, right? But
Yeah.
if you're able to save up that amount, it takes you, let's say, 3, 4, 5 years to save that up, and you pay in cash to avoid paying the interest. That's amazing. That's some pretty intense financial discipline, and you would do very well implementing this concept if you're that person. I'll tell you that right now. You would do
Yeah.
very, very well with this. But at the end of that time, you saved up, let's say, $30,000, and you go and you hand that check to the dealership, to the sales guy. You drive away with the car. That $30,000 that you had that was in an interest bearing account is gone. It has left your system forever. And yes, you're not paying interest, but you're giving up the ability to earn continued interest on the $30,000. So as you were saving up, let's say year one, you had 10,000, year two, you had 20,000, year three, you had 30,000. So every year you're continuing to earn more and more interest on that. And the second you pay for that car, you've lost that base of principal just when it was continuing to grow even more. And this is just kind of the norm. And of course, the other way that most people do is they pay a monthly payment with interest, and that money's leaving their system as well, and they're making the lender quite a bit of money. And we've talked about this before, but I think a really interesting thought exercise that any of our listeners can do is to go on socialsecurity.gov, especially if you have a W-2 job, and look at how much you've been paid over your lifetime. I've done this. It's kind of depressing. I'll just warn you. Look at how much you've been paid, and then look at how much of that money you have in your possession right now.
Yeah, it's like you said, it's going to be painful. We barely can think about it. Never mind take the step to go
Yes.
really look into it, and then we go, oh, we don't even want to go there, right? I've posed that question. What if you had access to every dollar that's flowed through your hands in your lifetime? And of course, you're talking to people at different ages, and the older you are, the worse it gets, probably, right? Because the number, unless you implemented something like this, the number's pretty big. And then you say, and do you have access to leverage that amount? Do you have it? Do you have it? And then it's almost like an of course not. Of course I don't. Who does? Right? I mean, that's kind of how people, it's almost like you're insulting them by asking that question, right? Because it hurts. So, or injuring them is probably a better way of putting it. You're just stabbing me here with this
Kicking me
pain
while
of
I'm
knowledge.
down. Well, and nobody's ever going to have access to all of that unless you're part of some multi-generational family that's been implementing this for a really long time, right? But so most people are never going to, but and I won't go too far into this, but it's worth looking at because there's something you can do about that, and that's our point.
Yeah.
And
And then, yeah, I'll add to that I'll say sometimes, or even close to that amount.
no, not no,
Like, so you might not have everyone, but do you even have close to that amount
correct.
available to you? And they'll say no. And so I want to go back to, again, I said the infinite banking concept is the creation of your own banking system. So, what is a banking system? A banking system to me is a warehouse of capital. It can be lent out, and when returned, it also returns a profit via interest charges, which is what people are used to doing, which we've just talked about. It can be lent out to you as the owner of the bank, the bank or the banking system, or it can be lent out to others. Depends on how big it is and how much people need. And, it can be family members, it could be friends, it could be community members,
Business
business.
acquaintances.
Yeah, just all kinds of, right. And there is a point in becoming your own banker that Nelson says, think beyond yourself. And I think a lot of us, including myself, might have said, well, you're thinking, hey, I'm going to pass this on. So it's this generational banking system or wealth system, but he's talking about even in your own lifetime. The more you put into it, the more that can be leveraged, the more that can be taken out to be lent to yourself or to others. And so don't be so myopic, so narrow-minded about it. Think about it, because what's happening is you've literally started a business with this. You know, we can look at business opportunities, right? And go, oh, I want to start a restaurant. I want to start a used car dealership. I want to make, sweatshirts. I want to do whatever, sweaters, right? I want to do any number of things. But literally you could say, hey, I'd like to start a bank. We can get into that a little bit, but there's a lot to it. There's a lot to actually creating a bank.
You're talking about a brick and mortar bank.
Yeah, I'm talking about, and what it takes to do that. And like that, no, that's not what I want to do. But if you thought you could create a banking system that you can utilize in your life, where your money your capital just keeps growing. Again, it's the concept of a bank. It's not a literal bank, right? And it doesn't work exactly like commercial banks, but this banking function is exactly how it works.
So you can replace the banking. Exactly. That's exactly what it's about. So like with the car, we gave you the two choices before. You finance it or you save up cash and you just pay for it and you don't pay any interest. What this looks like if you were to create your own banking system and replace the banking function in your life by implementing the infinite banking concept is you would pay money into a whole life insurance policy until you, and using our example, the car costs $30,000, until you have $30,000 that can be leveraged from that policy, and you take a policy loan and you buy that car, and that $30,000 of value, store of value in the policy continues to compound as if you did not take that loan. So you have not interrupted the compounding process and you've been able to buy the car. So you're not having to make an either or choice. Does that make sense the way I described that?
Yeah. And do I pay interest, Doug? Do I pay interest?
Yep. So you do owe. And so and of course here, there are different modalities that one could theoretically use to practice the infinite banking concept. But when you understand the attributes of a whole life insurance policy, you'll understand why Nelson chose this. And it's really the only good choice, in my opinion. And we have access to our cash value via unsecured loans, and we are paying interest to the insurance company. The caveat to that is it's almost always going to be a lower interest rate than whatever the market interest rate is. But what should we do, John?
Well, we should value our cash, right? And so we can basically borrow from the insurance company at a wholesale interest rate. So they're going to charge us, and we'll use an example of, say, 5.5%. And so when you lend it to yourself, this cash to yourself through the policy, you can then charge yourself, or if you lent it to somebody else, you can charge them more than what the insurance company is charging you. So let's just say I go in and I figure out what the payments are for 4 years, paying 5.5%, and then I say, well, what are the payments going to be if I pay 11%? Now, I said I was going to pay it off in 4 years at 5.5%, but I'm just kind of winging some numbers here, but they're probably pretty accurate depending on the amount that you're leveraging in the policy and borrowing from the insurance company. Is that instead of, when I'm paying at 11%, I'm paying it back faster because really I'm putting in bigger payments. My payment to the insurance company is based off the 5.5. It might take me 3 years. And let's say the payment is, at 11% is $400. At the end of 3 years, I could say, okay, I paid off the loan. Or I could say, no, I value my cash and I charge myself 11%, and I charge myself 11% for 4 years. So I'm going to continue to pay $400 possibly into the policy because it has room to accept it. Or you have a side account, which could be within the insurance company through a premium deposit fund, which we've done podcasts on that too. But you could just have it sitting, I don't know, in a box, in a shoebox. If you wanted, you just say, every month I'm going to pay $400 for that final year. Now I have $4,800, right? And if I can eventually either get it into the policy that I currently have, which is one of the branches, my first branch of my banking system, or I can eventually add another branch and another policy, whether it be on myself or somebody else that I have an insurable interest in, which could be a family member typically, right?
Typically, yeah. And I mean, it's following the same logic as your normal bank would do. So they might start off with one location. And once that became very profitable and they had a good book of business, they would then typically open up another branch. That's the step that they would follow. And we're talking about doing the exact same thing here.
Yep.
Like John said, paying off a loan early. I mean, two functions. One, you're going to have access to that pool of capital more quickly, so you're going to be able to leverage that again. And when you get to the point where you're just cycling through quickly, rinsing and repeating, it's typically time to open another branch and to open another policy. And that's where this really becomes infinite. And if you look at someone that is able to leverage their cash value to make a rate of return outside the policy, like by charging a higher interest rate to somebody or investing in something that they're good at that can return them back more capital, that's where this starts to become really powerful over time, because it allows that person to continually expand their banking system and to have these hubs that are, ever growing lines of credit that cannot be called, that can be used forever and ever and ever. And they're also providing a substantial death benefit.
Yeah, which is it's almost like a kind of an afterthought. But let's break that down a little bit, what you said, which is, hey, if we're paying at a higher interest rate, one of the things is that we're going to put the money back into our cash value or our available cash value again. So regardless of whether paying back faster or not, how long it takes and whatever amount of time it takes to pay it back, just to be really fully clear here, is that you're actually going to be able to leverage that money again. It's kind of like when you're paying back the principal and interest on a mortgage, for example. Well, the interest, that's a charge. Someone's profiting.
Well, it's like a home equity line of credit. I mean, in a way, right? So if I had $10,000 available of cash value and I were to take all of that out as a policy loan, once I've paid that back, even once I've paid back $5,000, I'm going to have access to $5,000. If I pay back the full $10,000, I'll have access to $10,000.
But be careful, right? Because when we do this, especially with people that say, well, then why is this better, right? Why is it better than a home equity? If we're going to use that as an analogy, and I know it was really just for that purpose, but it does get people thinking, well,
sure,
yeah, I already got that.
I've had that conversation many times. Yeah. I have a home equity line of credit, and it's much better than that. So for one thing,
the whole life is much better, right?
Yes,
is what you're saying.
The whole life.
So explain why.
I never use my home equity line of credit. It is just there, just because I don't know. I'm a pretty risk averse person, so if I can have an extra line of credit just in case, I'll take it.
Well, plus you just to add to that, you only can get it when the equity is there. So if the equity fell off because the market fell off, right, had a strong pullback, that equity's not available for you to go and ask for, right? It's or to apply for from the bank, right? It's
Sure.
right. So that's an important piece. That's probably why, right, that people, hey, take some, don't use it or don't get it if you think you can't handle it, right? Meaning you're going to just start spending because it's like a credit card, and I don't have to think about paying it back right now because right now I get the benefit of whatever I'm going to do with the cash, right? So.
Well, and I think that the home equity line of credit is good conceptually for people to kind of like grasp how this works. And it is different and it's superior, and I'll go into that, but it's the home equity line of credit is giving you a line of credit using your house as collateral, of course, right? So people understand that. And if you have a certain amount of equity, you can get a certain percentage home equity line of credit against that. Similarly, a whole life insurance policy, you have a known outcome with a whole life insurance policy that you are going to die. And believe it or not, we're all going to die. And the cash value is the net present value of the future death benefit. And that is a known number. And it's going to increase every year with dividends that are reintroduced to the policy, sharing profits with the insurance company, or return of premium, premium payments, et cetera, et cetera. And so as that grows, the insurance company is using that available cash surrender value as the collateral to loan to you, similarly to how a bank would use your house as collateral. The differences are that, one, the home equity line of credit is not going to grow. It's going to stay static unless you want to go apply for new lines of credit every so often. Two, it can be called. My bank could absolutely send me a letter in the mail saying, sorry, we don't really want to give you this line of credit anymore. And if there's something outstanding, you got to pay this back, in this amount of time, but it's done. The insurance company cannot do that. They're contractually obligated to give you policy loans as long as your cash value can support that, whenever you ask for it, no questions asked.
Also.
And also, you have a known, it's stipulated before you even get into the contract, how that works. That you can take out, nearly 100% of your cash value as loans. When I got my home equity line of credit, it wasn't up to me how they valued the house. The amount that they gave me, not that I'd ever use it, but it was ridiculous. It was a terrible evaluation on our house, even when you looked at what neighbors' houses had sold for and whatnot. So it was vastly lower than what it should have been. And if I had been relying on that, to do, I don't know, some home projects or a renovation or something like that, it would have been a problem. Since I have better lines of credit to use, it's no problem to me. But again, a lot of that was out of my control.
Mm-hmm.
And the last point that I'll mention is that my rates with the insurance company, the interest rate that they charge me is significantly lower than what I would pay in that line of credit on my HELOC. Significantly.
Yep. Again, I feel like we'll go back to this. So how do you put this concept into practice? We've talked about the dividend paying whole life insurance policy. You are part owner of this insurance company, right? So many people, Doug, will say, well, why am I going to pay interest to borrow my own money, right? Well, think about what they've just said, or if you ask yourself, that audience, you use the word the words my own money. Well, no, you're not borrowing your own money. You are paying interest, but you're leveraging yours. Yours, as Doug said, is continually growing and compounding.
And that's why you do that, so that you're not interrupting the compounding process.
Yes. And so that right there is, okay, I'll just pay whatever the interest rate is and I'll pay off the loan. And now I have access to the principal again. I can keep doing what banks do, which is when they take money back, let the money flow out, and when it flows back in, now they have it again to let flow back out to another borrower, right? And you're just keeping the money moving, right? And if you do what I had mentioned earlier, which is really what Nelson talks about, right, is to value your capital, to then pay additional, right? It's like a forced savings, so that you're saying my capital is actually, which I'm putting into the policy that I pay in through premiums, right? That capital that I'm leveraging is worth more than 5.5%. It's worth 11%. And it's a forced savings. And when you're putting it into a savings vehicle that doesn't decay, that doesn't fall apart, that doesn't have a hole in it where the bottom falls out, that it only ascends.
Mm.
It never goes down. It only goes up. In the growth period, right? It's only going up. It's eventually going to hit that current value, that's called cash value, is eventually going to be current all the way to the end of the policy. If you live to be 121, whether you live to be 101 or 91 or 81, that the idea is that you're moving the value all the way up to the death benefit. And that death benefit is continually growing because of this participating dividend paying whole life insurance, which means the insurance company is sharing with the policy owners in the profits, and they pay them out in dividends. And if you roll them into your policy, those dividends, they're not subject to the volatility of the swings of a market like the stock market. If you roll that into a stock portfolio, no, this dividend goes in and never diminishes in value. I mean, certainly the nominal value, the number. Of course, yes, it could diminish in buying power, but no, it's always going to continue to grow, which then
Yeah.
drives the policy death benefit to continue to grow, which forces the cash value to continue to grow. And this just goes on. And then we do the circular thing of a banking system, which is to lend the money out. When you pay it back with a profit for you. And that's how you can do it, is by paying an additional cost for leveraging your capital. And then you just keep building this system. And then the system means you could have branches just like a brick and mortar bank.
Or stipulating that people that you lend the money out to, pay back at that rate, that same rate that you'd want to pay back into your system.
Yeah, whether it
Yep.
be you doing it,
Yep, you or anybody
someone
else,
you
but
lend
you
it
just
to.
want to make sure that that loan is being paid back as if it were, the current market rate for that or higher. And the quicker that you can rinse and repeat and continue to take advantage of leverageable opportunities, the faster your banking system is going to grow.
Exactly. I mean, that's the crux of it, right?
Yeah. And I wanted to say too, when you were talking about uninterrupted compound interest, most people don't have really, I mean, maybe if some people have a savings account, they might see that, right? But other than that, this is one of those unique things that is always going to go up and it's never going to go down. And I know that sounds kind of silly. It's very simple, but most people are used to putting their money into stock-based accounts, 401ks, IRAs, taxable brokerage accounts that are just going to be always, typically over time they do go up, but they have a lot of downturns as well. And this is something that is just, it's just notching up every year, exponentially more every year. Because like you talked about, the reinvestment of the dividends it becomes very powerful. A couple decades into these policies, the dividend payments often exceed the premium amounts. And The one nice thing that I'll note, unlike a typical dividend reinvestment, which is a taxable event, with this, it's because it's classified as a return of premium. That full amount of money is staying within your system. The IRS is not touching any of that. It's pretty unique. Actually, I think it's extremely unique.
Oh, yeah.
Um,
Yeah.
yeah.
Unless we don't know about something out there in the world, that this is the only one that works this way. It's the only asset that works this way, that is, when utilized correctly, is tax free.
Yep.
It will, and you're paying into the system with so-called after-tax dollars, right? But you're paying on a smaller amount, and this number is going to keep growing. And so when you decide that you want to maybe stream some of it out is cash flow, I don't like the word income, and in fact, this isn't, because it's tax free, I call it cash flow, but it's like income. And when you may want some income for your life, it comes out tax free. And it's a much bigger number than what the numbers were you were putting in after tax dollars. It's you're paying on the seed, if you could just pay on, the piece of raw land, as opposed to, say, real estate taxes on the piece of raw land and never pay again, right? And not pay when you sell your house, not pay real estate taxes while you put a structure on there, a home, and so forth, right? You're living the harvest in a tax-free way, and that's how the policy works, right? Is that when the fruit and the vegetables in the field come ready in time for you to harvest them, you're not paying anything additional. You got a lot more value there, but yeah, you paid on the small side and benefited on the large side with no taxes. So
Hmm.
yeah, I don't know if that was clear or not, but
I understood it.
yeah.
Yeah, I mean that we can get into that, well, we've talked about that on other episodes, but the tax benefits of these policies are second to none.
Well, and I know that when we recorded this the first time, it flowed right out so nicely, but Doug named his company Control Capital Solutions, and keeping the control
Hmm.
of your capital, because when you do this with a traditional or conventional brick and mortar bank or online bank, when you do this with capital, you're paying out of pocket, so to speak. You're putting your cash into it by paying off a loan, right? And you've lost control of that capital. That's why it's so important, and that's why you named your company.
Yes.
It's controlling the capital. We have solutions. You have a solution for that.
Yes. Well, you're making the bank money. You're making them money. They're making a lot more money, on even if they're paying you interest, they're making far more money on the money that you hold in their account, that they hold in your account, than what they're paying you in interest. And if you're paying them, interest for a loan, you're making them money, and they stipulate all of the rules. And Nelson talks about that in his book. He who has the gold makes the rules. And this system, this solution that we're talking about, is a way for families to intergenerationally take back control of the banking function in their lives. And this is a long-term play. This is not a get rich quick scheme. This is very simple. It's quite legit. This has existed for, a very predates any stock market type investing accounts that people are familiar with, going back to the 1800s. This is a very commonly used savings vehicle that just kind of fell out of favor really about 70 years ago. And it has innumerable benefits that can be put to use. And this is not about doing this or, putting your money into real estate investments, or doing this or putting into the stock market. It's about saying, why don't you put your money here first and fund this system for a little bit of time, and then run everything through it so you can do this and the thing that you want to do. And that way you're not losing your money out there. It's staying within your system and you have control, just like John talked about. And that was very well said. Thanks, John.
I'll try not to screw it up by saying something else. Thanks, Doug. It's funny, right? Because we throw around this phrase, it's not a quick get rich quick scheme. Can't even say it. Get rich quick scheme, right? Scheme sounds almost like scam, and but scheming, doesn't sound like a positive thing for someone to be doing, especially if they're doing it to somebody else. But it's funny, right? If maybe there is a get rich quick scheme out there, and what if you had a policy that you could take advantage of that opportunity that was a once in a lifetime opportunity? I'm not suggesting people go out and, do anything in particular, right? But I could use the fact that, there has been opportunities, I'm sure, that did make people rich overnight, right? Or what they felt was rich. But what if it was, I don't know, what if it was a $10,000 investment to make, I don't know, a bunch of money, whatever it is. And you had it in your cash value and you just borrowed it from the insurance company against your cash value. And you put it into whatever you did and it made a whole bunch of money. I mean, what if it made 100,000 just for ease? Doesn't mean you're rich, but let's just say it made 100,000. And then you pay it back. Now you've got, let's just say it happened really quick. It was quick. So I paid it back. I hardly paid any. Well, let's just say you put the 10,000 back. Now you got 90,000. What are you going to do with the 90,000? Well, you could figure a way to maybe, find another get rich quick scheme. But how about starting another branch of your bank? Start putting that in, put another branch, because we don't have to gamble. There's a lot of good opportunities that will come along for people to do something they enjoy, and it might, turn a buck. It might make some money for them. But now that person has the access to the 10,000 again, and they've already started to expand their banking system, right? They got to put the money somewhere, right? So that's one of the first things is you're warehousing your capital. And then you can do the banking function in your life that is, as Nelson says, businesses come and go. But banking is, again, eternal. It's forever. There's always
been around since the dawn of time.
Yeah, there's a need for the banking function. It's a matter of who plays the role.
Yep. And it's one of the most, I would say, the most lucrative industry that you could be in.
Yeah. I just went into a bank because I needed to have something notarized. And I mean, it's a nice looking building from the outside. It's not enormous like you'd see in a downtown city, metropolitan area, but it's a pretty brick building. And I had never been inside of it. And I went inside, and the first thing I said there was the tellers looking at me, and I said, "Wow, it's really beautiful in here." It was really nice. And I feel like that's what you're doing, is you're literally building this beautiful thing. It's not the brick and mortar, but you're just continually adding on because you need a place to warehouse your cash. And then you need a place to run this function of banking within your life. And you know what? You can build it big enough to do the banking and financing for others. And wow, that was so easy. All I did was go get a life insurance policy. And I started this banking system. I got into the banking business because they've got the whole infrastructure, Doug. Yep. They've got all the employees. They've got all the systems. It's like a franchise. You just plug right into it. I mean, that's amazing. It's simple. It's probably the most lucrative business to be in, but it might be one of the easiest businesses to get into also.
Well, when done this way, not,
Yeah,
not
when
setting up
done
a
this
typical
way.
bank. Yeah. Yeah, it's very easy. Everything's contractually set out. They've been doing this for a couple hundred years, so they certainly know what they're doing. They are much better allocators of capital than I am, for sure. And I think we've talked about this before. One of the most beautiful things for me about implementing this and driving a lot of my free capital into these policies is that I don't worry about my money. I sleep very well at night knowing that they're in there. I'm not worried about volatility, fluctuations, bank runs. It's just, it's safe, it's secure, it's ever growing, it's contractually guaranteed, and it's a beautiful thing. And then there's so many things that I can do with it. Um, so yeah,
And you're
I
one of
mean,
the you're the number one customer. You're the best customer, right? Because you just keep giving it more. You just keep feeding it more. And you literally could have what Nelson calls, he calls you a captive customer, but there's other people that like you, trust you, and they want to do business with your bank. You want to do business with them because you like and trust them. If they borrow from you, they're going to pay you back. I mean, but if you don't have the capital, you can't take advantage of things. You can't keep control over the banking function in your life. You can't do it for others, right? You can't do it if you haven't warehoused your cash in this place called your banking system.
yeah, well said. Well, if anybody has any further questions about this, please let us know. I mean, I know that I needed to go and reread and re-listen to many different things before this kind of clicked in my head, because it's very different than what people are used to hearing about. But it is real. It's something that people have been implementing for a very long time. And it is not an investment. It is about replacing the banking function in our life and creating this leverageable pool of capital. And it's really as simple as that.
I
So
agree.
again, if anybody has any questions, please let us know. I hope that this helped clarify a little bit, but we do look forward to your feedback.
Yep, certainly do. Thank you, everyone. Thanks, Doug. Really
Thanks,
appreciate
John.
you doing this. All right.
Yeah. Hey,
All right.
you have a good
You have
one.
a great, yeah, you too. Thanks. Bye-bye.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.